Let's see. I got the socials here. Okay. All right. Well, let's dive right in. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
How you doing, Kirk? Hey, no battles today. There's enough battles going on in the world. You and I, we got to get along. So let's keep this civil, okay?
We always do, Doug. We always do.
Of course we do. No, it's just crazy. The world's crazy right now, Kirk. So obviously that means there's a lot of fun things. But then you know what? For a long time, everything was just kind of tick, 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 status quo. We already started talking about rotation. We already started talking about things changing. They already started to do that. And, we're living in a new world, right? The president obviously was never going to war, has gone to war now. This does not sound like it's settling out. Lots of fun things to talk about, and the impact of all that. So.
Yeah, we won't get into the politics of it all, but I will say that
the markets, economy,
yeah, the economy, yeah. I mean, I think it's interesting. So I've had this conversation with a lot of people over the last 2 weeks, obviously with the war going on. Without getting into the politics of it all, I do find everybody's opinions on it fascinating. It is all over the map. Like what people think about this, what they think is going to happen, why, whether it's good or bad. Like I've heard so many different opinions. I find that fascinating. Because what used to happen is you used to have one opinion or two opinions. You'd have the Democrat opinion, the Republican opinion, but you're not getting that anymore. Now you're getting Democrat opinion, the public opinion, but then on the Republican side, you're getting like 20 different views. On the Democrat side, I don't even know what the view is. The party's a shit show. I mean, the people, the Democrats themselves have their view, but the party's a mess.
Well, what is a Democrat or Republican these days? Not to get into politics,
you don't even know.
It's now fractured so much. So.
Yeah, I mean, if you think about it, like the Republican Party is led by Democrats. Trump's a former Democrat. You have RFK as a Democrat. Tulsi Gabbard's a Democrat. You've got virtually everybody there is a Democrat. What was Vance? Was he a former?
I don't know if Vance ever was. I should know this being from Ohio and that he is, but I don't think he was.
I don't remember. Anyway, the point being is the party system's a mess.
Yeah.
And so you can't take your old framework to apply it to the way things operate now because it's just not the same. Because, I mean, Trump is the anti-war president. He's going to war, and we still don't even know why. So, but anyway, I do want to say...
I need to say something really funny because it kind of reminds me of years ago from the Iranian president at the time. If you remember Ahmadinejad.
Yeah.
Which, by the way, one of the funniest things I ever heard is how do you remember it? Just, I'm a dinner jacket. That was one of the funniest things I ever heard. Like, if you can't say his name, just say I'm a dinner jacket. It was a comedian said that. But he talked about at the time that the Iranian government was way more democratic than the U.S. because we had Republicans and Democrats, two-party system, and that the Iranian political system had like hundreds of different political parties. Of course, we all know they all answered to the one supreme opinion, right? But it reminds me now, I just want to say this, that the way that the Democrat and Republican parties have fractured internally. Yes, by name, we still have only two, but it reminds me now of the Iranian politics. There's a what you are, it's like subcategories of divisions. Anyway.
Yeah, I mean, the interesting thing is the Iranians are where they are now because of us. Like before, they were a normal society, and then we caused them to be this way. So I think if anything, we should just get out of everybody's business. But anyway, that's enough of politics. But yeah. I do want to suggest this because I've been watching the markets very closely over the past 2 weeks. So I want to kind of share my thoughts as a portfolio manager, investor, and all that. Is that a bunch of realizations I've had, and I'm going to kind of walk through them here. Now, the first is when you that freeze. Sorry, my computer didn't like that. The first realization is that we went to war. People were talking about maybe we will, and we don't know when. Maybe it was going to be 2 weeks from now, and then oh my God, they all got in the same room, all that stuff. I don't know how true. By the way, we talk about the fog of war in the past. This is true for anything. Any new news, there's a fog of war. You don't know what the truth is. We have no idea what's going on over in Iran. We just know what people are saying. We don't know if it's true or not. We have no idea. We know what Trump's saying. We know what the politicians are saying. We know what the media is saying. We don't know if any of it's true. So just keep that in mind. And I'm not saying it's not true. I'm just saying we don't know that it's true. We have AI videos online everywhere that are from video games, and people are like, oh, look what's going on in Iran. Or like there was an explosion over in China. I was reading a thing this morning, and there was a huge industrial explosion in China. It looked like a nuke went off over there, like a mushroom cloud. It was enormous. And people were taking that and like, look what they did to Iran. It's like, it wasn't even Iran. It was like China. So you see all these deep fakes and all this fakery online. You don't even know it's true anymore. And it makes you kind of crazy. So I've talked about this for a while. Tune out the media. Don't watch the media. This is completely useless. Every single one of them is completely useless. You might say, whoa, I like this person. I'm telling you, it's all propaganda. It's just a different version of propaganda that you happen to like. It doesn't mean it's not propaganda. It just means you like it. It means they're tending towards your sensibilities. And so you like it because it agrees with you, right? Our brains, we have an ego. We like our ego to be stroked. And when somebody says something that we agree with, hey, that makes me seem smart because they're saying something. That's how your brain works. So it's better just to, get rid of the pollution and just get rid of it altogether. But that's another topic. What I do want to talk about is the markets. So if you're looking at the market so far, and if you look at what's happened, and I was trying to share something, but my screen froze, so I'm going to have to do this by memory. But if you look at the markets, so when the war started, it was, let's see, we saw the first day was up. That Monday, it was up. Tuesday was down big. Wednesday was up. Thursday was down big. And Friday was up. And it just going back and forth and back and forth. Now, this week, the markets are lower because the first week they assume, oh, it'll be quick. Trump will be in and out, just like they did with Maduro. Well, apparently that's not what happened. And so the S&P has started to glide lower. Now, here's something to keep in mind. When war happens, whatever your game plan is, whatever your thesis is, it's out the window because we have no idea what's going to go on in the markets. We don't know how long it's going to go. We don't know the repercussions. We don't know, whether there's infrastructure that's destroyed or that's going to impact, whether you're going to be, they're talking about mining the Strait of Hormuz. I don't know if any of that stuff's true. I just hear reports, but you don't know if it's true. So we don't know the extent of this so far. The way I look at what the reality is I look at how the market's treating it. The market is smarter than anybody listening to this podcast, including me, including Doug. The market is everybody's collective opinions, including some of the smartest people in the world. If some of the smartest portfolios managers in the world are selling, there's probably a reason for that. And you might want to consider it too, right? That's how you should be thinking, is what is the collective intelligence telling you? Well, last week, the collective intelligence was, hey, everything's fine. The water's fine. It's okay. It's going up and down a little bit. We'll all be fine. This week, okay, maybe things aren't so fine. It's not terrible, but not great. Next week, maybe more of the same. Maybe it's just like, well, things are still going on. Maybe they'll, Trump's like, oh, it'll be quick. And it's been 3 weeks, so maybe it's not that quick. So reality has been seeping in slowly, whereas normally we get like a flush. Things just shoot down, shoot up, we're done. This is more of a, let's just kind of like take the steam, let's take the wind out of the sails a little bit and slow it down. So what we've seen has contradicted to pretty much what virtually every single person has said. Now, pretty much everybody has said, you know what? The dollar is going down. They've been saying this for the last, 3 to 6 months. The dollar's going down. It's going to get destroyed and it's terrible and blah, blah, blah. The gold's going through the roof. And, what happened when the war started? Dollar went up. Everyone's like, I don't understand. What? It should be going down. Yeah, but it went up. What that should tell you is your thesis is wrong if you think it's still going down, because it didn't go down. So what I want you to keep in mind is that whatever the thesis was, whatever the trends were, and I had mine for sure. I had a lot of allocations on that I've gotten rid of because they're no longer valid at the moment until the war is over or we have clarity. So I've removed a ton of my positions because I put some on literally a few days before the war. I didn't know. And I was like, oh crap. I mean, we had bonds in there I got rid of. Like, bonds weren't participating the way I thought. I thought, well, people would be fleeing to bonds. They're not. Like, what's going on? Like, people are going to cash. That's about it. So we talked about this last week that when you see days where everything's red, you have it. You probably don't have a screen like I do, but some platforms have them. Like Think Pipes through Schwab, they acquired TD, which acquired Thinkorswim. Great platform. You could have these screens where you've got like 50 stocks on the screen at the same time. You can see all the performance all happening at the same time. I had a screen that was all red. The only green I saw was the US dollar. Everything else was red. All of the stocks I was watching, that and software stocks. But why? Money is going into the dollars, going into cash. It's deleveraging. Leverage is coming out of the system, which is a healthy thing. The problem is that should be dropping prices more, but it's not. It's just things are shuffling around more. Things are moving around. International got hit hard last week. Precious metals have not been going through the roof like you would expect they would in prior wars. The US dollar has been doing really well, which is a surprise just about everybody. We had a CPI print, which was not favorable. It wasn't terrible, wasn't great, but slightly not favorable. So people were worried about inflation hitting, which they should be. If you have $120 oil, you should be worried about inflation. But here's the active thesis to think about, is that initially oil went up a little bit. Okay. Then this week it spiked up to, I don't know the actual price. I'm just going by the stock, but I think it went up to 120 something, 125, something like that. I have to look it up on the futures. My computer's not treating me well today. But the USO, which is a reflection of oil, went up to 125, and it was normally down to around 70. It's almost doubled in like a few days. It just spiked up. And today, right now, it's at 118, which is still pretty elevated. So is it going to get worse? I think at some point it's got to get better. It's hard to believe it's going to stick up at 120. That would be very bad. And if Trump wants to maintain power, it's definitely not going to be good. So when you think about portfolios, you might have been hot on energy. Well, you were lucky and that did well because energy has been hot for the last, 4 months, maybe 4 or 5 months. It's been really hot. So you were lucky and energy's generally done well. Not every day, but overall it's done well. Exploration, and that's done well. Like there's some pockets of energy that have done very well. But if you look at all the other areas, even the safe areas, staples, a safe, that hasn't done well. Utilities has actually been surprisingly resilient. But pretty much everything else has more or less not done great. But the S&P is just kind of hanging out. The Nasdaq's just kind of hanging out. It's within its range. It's at the bottom of the range right now, or close to the bottom, but it's not at the bottom. Like it could go lower. So when you think about the war, like how things are operating, what is your thesis before? Is it still true? Well, I would argue that my thesis from before, in hindsight, I probably would have got out on everything on day one. In hindsight, that's what I should have done. Just dump everything day one. But I didn't, because day one was like, the market doesn't seem to care about this. And then day two was like, okay, now it cares. So when you're in doubt, the best thing you do is get out. It's a great line. When in doubt, get out. You can always get back in, right? I don't care if you're Warren Buffett. It's okay to get out. You're not managing $100 billion, most likely, if you're listening to the show. You're just normal, average person. Maybe you're a financial advisor or an institutional person, but you're probably not making big decisions and judging them based on us yahoos. So if you're not managing that much money, then you don't have to worry about getting out. If you're managing that much money, it might take you weeks to get out of a position. But for everyday people, you can get out of a position in a day, in a minute, in a second, right? So when in doubt, get out, and then wait until things clear up or are more clear in the direction, and then you get back in. So I've added a few things over the last 2 weeks. But in general, I'm looking at this, and every day I'm looking. It's like, what should I reduce? What should I get out of? Should we get out of more? Should we stick it? Some things have held up, but we just got out of them because I'm just going to wait. So I missed 10% on a move. I don't care if it's a strong theme and a strong move. There'll be plenty of money to make, right? I would rather miss out on a little bit of upside than to participate on a lot of downside. I've been doing this 26 years, and I can tell you, I've seen this time and time again. People get suckered in, and it feels like this is kind of what's happening. If the war lasts another few weeks, people keep getting suckered in. It keeps going down, and people are like, well, it'll turn around tomorrow. It'll turn around tomorrow, and then it doesn't. So just be careful. That's a very common thing that people do. So I hand it over to Doug for a minute, but I just wanted to state that war is one of those things where when in doubt, get out. It's better to sit in the sidelines and wait until things are clear, because I'll tell you this, when the war's over, we might have different themes. Prior to the war, my theme was lower bond yields, and the dollar would probably stick where it was, would just kind of go sideways for a while. The boring stocks would start to do well as they were. Energy industrials were doing well. Staples, they were doing well. Like Staples is the best performer, I think, up till that. So you look at those areas, I'm like, they're doing great. Are they going to do great if the war ends tomorrow? I don't know. I'm going to wait to see, because the theme may have changed. We may have more inflation, which will probably impact Staples, right? And it'll impact a lot of areas. But if oil crashes to 40, maybe Staples are more interesting again, right? So you got to think through these things. That's why, don't get too eager to pick the bottom. Don't get too eager to buy the dip. Believe me, you'll have plenty of opportunity. The market may go sideways for the rest of the year, for all I know. For all you know, it could go sideways. It could just go sideways the rest of the year. That's very possible. So just keep in mind that you don't know what the future holds, but just be patient and wait for clarity rather than trying to pick a bottom, because if we're in a bear market, picking the bottom leads to more losses, not more gains. What are your thoughts, Doug?
Well, yeah. So what, kind of my thoughts going into this is, first of all, the war trade, I believe, it's already crowded. Okay. I mean, if you take a look, and I think you have a chart that also talks about how, bearishness, the amount of hedges that are already on there, have already basically argued that we may have priced in a lot of the worry. But then again, as you said, with war, it's a lot of news. It's a lot of, there's a lot of AI. There's a lot of things that are, spin. So you don't really know what's going on there. And of course, there's two components to war, especially in the modern war era. And we've seen this time and time again. First of all, one of the highest approval ratings ever was when, George Herbert Walker Bush invaded Iraq, during the Kuwait War. We went in and we declared victory very quickly. It was almost a 90% approval. His son got somewhere in the 70% approval after they went in and, of course, did the second Iraq War. But what we have found in most of the modern era, when I say that, I'm talking about the 60s to present, is that, war has changed a lot. And there's also been a lot of learn about, again, who we're in conflict with, that basically states, there's going in and there's winning it, the initial big equipment, big weapons, big sustained, boom, we attack, we take out infrastructure. But it's completely different once we get into the longer end of it, of trying to deal with, if Iran was declared victory tomorrow, we saw this with Afghanistan, we saw this with Iraq before, that it gets very different the longer you're there in maybe even an occupying position. That's extremely expensive. And so we haven't even gotten to that part of that fast victory, as far as we know, to even get to that point. And so there's so many things that can come out of this that are unexpected, that can then turn and sour things, that might still be holding strong. And now, I mean, for the year to date, the S&P 500 is only down about 2.6, 2.7. That's not bad. The last month, it's only down about that amount. So we were flat for the year. We've given about roughly 2.5%. That means the markets really haven't reacted much to this. But there is already a trade going on that's crowded. Energy, defense, gold, obvious trades last week. This week, the bigger question is whether or not that's already too crowded. When the same trade gets consensus fast, the markets will often reverse or stall. We are starting to see gold pull back a little bit. Interesting enough, we're starting to see Bitcoin go up. Although it's already given up so much, in the last 6 to 12 months that it really, some would argue, it only has one way to go. It's holding, but it's kind of bouncing around this trade area. Silver's giving back a little bit, right now. So, the question, the real opportunity now is possibly going to be looking at, is either going to get out to safety and just watching and waiting because there's so much uncertainty, or looking really closely at what, in areas everyone abandoned. By the way, I had a conversation. I just posted this chart with someone about, the S&P 500. We've talked about the concentration. What is interesting is that, the U.S. concentration of the weight of top 10 holdings of each country's ETF, the 25 largest countries. Interestingly enough, USA, as concentrated it is down there on this list of 25 countries as the third least concentrated. Japan and India are the only two below us. If you look at Canada, China, UK, going all the way up, the average concentration or the weight of the top 10 holdings of each country's ETF is actually 67%. So if that, so when you're looking at, you talked about the international trade, collapsing, a lot of the run up of the international trade, if we're trying to get away from concentration in the United States, trying to get away from, that rotation into finally diversifying into international. Well, interestingly enough, it's showing that there was and may still be more concentration, and actually that creates more risk even in those non-U.S. trades. I want to go back to oil volatility. It's now, I believe it's going to be the Fed's biggest wild card. They spent 2 years trying to control demand-driven inflation. Oil shocks. I mean, there was some influence based on what's going on with Venezuela, what went on with Venezuela, and now Iran. But really, I mean, beyond that, oil shocks are outside their control. And if oil volatility persists, this is going to create a challenge for them on inflation. It's going to be harder to predict, and rate cuts, which has been the talk with the new Fed chair coming in, those are going to be harder to justify. And that uncertainty alone could keep the markets very choppy. The other thing that's happening down there at the bottom is the consumer is quietly tapping out. U.S. consumer has not collapsed. The top financially solvent, Americans have held a lot of this up. But I've been talking about this now for a good 18 months, that at the bottom end, the pain is being felt. And I know personally, just from working with individuals who are now in that, mid-tier, middle management to upper management, they are starting to get notices that they're potentially going to have job risk. And that's going to, now lead to the biggest spending component, not necessarily en masse, but the biggest spending component in terms of affordability at the household level, starting to feel pain. And the U.S. consumer is starting to slowly run out of margin. We are continuing to see rising credit card balances, higher delinquency rates, weaker discretionary spending. Oil spikes act like a direct tax on consumers. When you go from $2.50 a gallon immediately up to $3.50 a gallon, like we're seeing in certain areas, and other areas have got it much worse, all of a sudden, every time you fill up, it's an extra $35, right? And if you're still driving into work, not everybody's remote, people have gone back. You're now looking at, over the course of a month, potentially hundreds of dollars more. And a lot of consumers just don't have that wiggle room with all the other things we talked about, like student debt, higher credit card balances, which means they're now having more of their cash flow sucked to maintaining those minimums. The pinch is getting real. And housing just got hit again. Mortgage rates, right as we get into the spring season, this is the time of the year that we start to see housing transactions occur. And we were going into it with some positive opportunity. We saw, mortgage rates had come down. They were back to, arguably, you're starting to hear the rhetoric that might be affordable again, that we might see mortgage rates, actually fall further. that could spike a demand. Well, now just in the last week, mortgage rates ticked higher due to bond volatility, which we had been saying bonds, watch the bond yields. They've been pretty consistent. Now that's another double squeeze. So higher borrowing costs, higher cost of living from energy on top of that too. Now, housing doesn't crash immediately in these cycles. It simply freezes. So if we're going into March now with higher mortgage rates, we are at the risk of another season in which housing could be locked up. And that is not going to bode well, especially as families get into a situation of trying to potentially make last minute adjustments to tight cash flows, especially with job losses. Another place, small caps, they're flashing a warning. Large tech names are still holding up relatively well. So the S&P is down 2.5. Small caps, again, they picked up, they were doing better, but now they're lagging badly. And that tends to be, because they're more sensitive to credit conditions, they're more exposed to domestic economic slowdown. So the markets may be signaling Main Street stress before the Wall Street stress. You mentioned the dollar's going up. It's actually getting strange. Normally, war plus risk equals a stronger dollar. It has picked up, but we're also still seeing more central banks buying gold, emerging markets diversifying reserves. So a dollar may spike in crisis, but confidence trends are still shifting underneath. And that's going to lead to the markets repricing geopolitical risk. For years, the markets assumed it didn't matter. You hear that. Now we've got Ukraine, Middle East, Red Sea shipping disruptions, global supply chain risk. Geopolitics are moving back into market pricing models, and that could be the start of a new volatility regime. For much of the last decade, Kirk, markets were dominated by low rates. We talked about how that helped, especially with technology and growth, a growth-driven environment. I mean, that's why value lagged for so long. We had stable inflation, we had liquidity support, and now this rotation, this shift could be, more commodity volatility that just ripples through the economy. Geopolitical shocks, higher real rates. Investors are going to, that are built for the old regime now may struggle with the new ones. So the real risk right now going forward, two more things, is policy mistakes. The markets, they can absorb these shocks, but they struggle when you get price policy miscalculation. So a lot of pressure right now on the Fed and the government. If they cut rates too early, that could backfire. If they tighten during energy shocks, that could backfire. Fiscal overreaction. So the biggest risk may not be the war at all. It may actually be how policymakers respond to that. And that's going to be when portfolio structure matters the most. When markets are calm, almost any strategy works. But you and I have talked about this. I think between rotation and now all these other geopolitical forces and new Fed chair and all of these other things going on, is we're getting back to a point in which you really need to be aware of what you're holding. And that volatility is going to hit things more when you're going to feel more issues with concentration risk appearing. Liquidity. Again, cash is king. We said it right now. You mentioned bonds haven't necessarily done what you want, but they also haven't imploded. So they've certainly been, showing, especially on the long end right now, they haven't really grown the way we'd expect them to do with risk, but we certainly haven't seen them collapse. So they are, at least at this point, still pushing as a stable value or a place to at least prevent, risk and decline. But liquidity, cash is the one thing that you can use to also buy into a market if it resets. And this is also where income planning matters and cash flow matters. And this is where discipline planning is going to show its value.
Yeah, no, that's great insight, Doug. Yeah, I want to kind of state this. I'm going to share a few important charts here. Is that one of the most important concepts you can ever learn when investing is risk management first. It is one of our core principles here. We call it risk management first. And here's the thing behind it, right? If Doug has $100 and I have $100, okay, and we put it in the S&P 500, and I decide to take it out, and Doug leaves it in, it goes down 50%. Now Doug's got $50. I've got $100. I can buy twice as much of what Doug owns because I wasn't losing money when Doug's stuff went down. So my cash effectively went up 100%. Now, I know this is weird to think about, but investing is all relative. One thing relative to another. Your cash relative to your investments. Your gold relative to your bonds. Everything's relative to each other. If you pick one thing, you're choosing another, right? If you pick one thing, you're not choosing another. I mean, and if you're selling something, and you're choosing something else. So you're always making this exchange, even though you don't necessarily see it or feel it. But that's what's happening. So if you don't want to lose money, then cash is a good option. Now, you don't hold cash for 50 years, or you're definitely going to lose money to inflation. What I'm talking about is we have a war going on. We don't know what's going to happen. I could guess some things that could happen that, if they did, would be very bad for the markets. But we don't know if those things are going to happen. So why take the chance? The risks are high of bad stuff happening. So let's just sit in the sidelines and wait it out. Wait till Trump gives the all clear, right? Like he did in the tariff tantrum when they call it the taco trade. Trump always chickens out. At some point he's going to chicken out because people are going to get upset with him. He's like, well, I don't want people to be upset, so let me just get out. That's going to happen at some point. I don't know what that means. I don't even know what's going on there now. No one does. So I think at this point, sometimes sitting in cash is a good thing. Don't be afraid to sit in cash. All these yahoos that are telling you, well, cash is trash, like Ray Dalio says that, which is garbage. Cash is trash and you're going to lose money to inflation. Yeah, you know what else you're going to lose money to? A falling stock market. So inflation is the least of my worry right now. And if I lose 1% to inflation, I'd rather do that than lose 50% to the markets. So just keep in mind that whatever you're invested in is always subject to some risk, whether it's cash or stocks or bonds. There's always some risk to it. You just need to figure out which is the best risk to take. Now, for me, when we have these unresolved or undiagnosed risks that nobody can really figure out, sitting on the sidelines is perfectly okay. You don't have to play. What's the line from War Games, from the Matthew Broderick's War Games from the 1980s? Sometimes the best strategy is not to play. That's the truth. Sometimes the best strategy is not to play. So I want to go through some updates on what the market's doing, because I think it's important to recognize. And why is this thing not? I don't know. This screen is not allowing me to share. Doug, what are you doing to my screen, Doug? It's all your fault.
It didn't do it, Kirk. You don't give me that
I have
power.
no idea what's going on here. This thing is not. Okay, well, I'm just going to have to go. But there we go.
I have lost. Oh, go, Kirk.
Okay.
He's back.
Yeah, this
All right.
platform is buggy.
I was playing solo for a second.
Yeah, I'm not going to give the justification of the name of this platform because they're buggy today. Anyway, so this is the performance this year for the sectors in the S&P 500. You see here, obviously leading is the energy sector, but it was actually doing well prior to the war. But the energy sector is up 26% this year. Materials up 10, industrials up 9.5, staples are up 9. Oh, 9%. Utilities, the boring utilities that are basically an income play, are up 9% this year. What are the worst performers? XLF, that's the financials. You've got communications. You've got communications up here. You've got discretionary. You've got technology. You got healthcare. You have a lot of poor performers here. Now, what I want to share is, if I get the screen to operate properly, God, it's gonna bug me. Is financials are not doing particularly well right now, and a lot of that is due to what is going on with private credit. Now, I'm going to share this chart here. So private credit is effectively what's taken over the banks. So prior to 2008, the global financial crisis, banks were doing all the lending. They were lending to just about everybody. Now the banks are doing a lot less of that because there's risk and they've got a lot of restrictions. So a lot of that lending that banks wouldn't do went out to the private markets. And the private markets are run by big institutions like Blackstone, KKR, Owl. You've got Carlyle. You got a bunch of those that effectively have invested into private credit funds and all that. And the problem with private credit is that the standards are not regulated by anybody. And so you could have a lot of problems in the private credit space because it's what we call the shadow banking system. China had this problem a few decades ago, the shadow banking, where they had all this lending going on that you had no idea what was going on because there's no oversight, there's no regulation, it's just happening. And that's what's going on in the private credit space. Now, it doesn't mean it's all bad. I'm not saying private credit's all bad. But when you get a group of really wealthy and smart people get together and say, we're going to make a lot of money in this, kind of like what they did in the banks in 2008, we don't care the repercussions. We're going to make a lot of money. And if we get screwed, then we get bailed out. I think they basically found a way around the system. So here's basically how it works, just so you have an idea. A fund, let's say Blackstone, decides to fund a AI company, right? So they loan money to an AI company and they get a good rate because the AI company is a little risky. So they get a good rate. Maybe they get 10% instead of the normal 4%, right? So they get 10%. Okay. So they get that 10% and they put it into a fund. And they get about 100 other companies just like it and they put it into a fund. And then they manage that fund. They make money off that fund. Now, the fund is basically generally tied up. You can get redemptions. I mean, if you invested in the fund, you can get your money back. But if everyone wants to get their money back, then they say no one's getting their money back, which is what happened yesterday in Morgan Stanley, is they said, we're freezing redemptions. Blackstone, KKR froze redemptions a bunch of weeks ago. A bunch of these firms have froze redemptions because people just want their money out at any cost. They just said, no, we're not doing that. Now, this is also what happened pre-2008, is you have this situation where you had a lot of funds freeze redemptions because people wanted their money out, and they just said, nope, sorry. Here's the good side and the bad side. The good side first. These are not banks. Banks leverage 10 to 1. So if you have $1 million and you lend out 10, you can make 10 times your leverage, right? That's how the banking system works. The downside is you have more leverage, which means it's more dangerous, which means if you're lending money and they all fail, you're bankrupt a lot quicker. Now, banks have a little bit more wiggle room because it's just by the nature of how they're set up now. They've got a little more wiggle room to not default as they normally would. But the private credit space, not necessarily. However, they're not necessarily leveraged. They might be a little bit, but not 10 to 1, maybe 2 to 1. It depends on the fund. But most of them are not leveraged, which means that there's not a cascading effect like there was in 2008. Here's the problem. These private credit funds, what they do is a lot of them get warehouse lines of credit. Okay, this is a common thing in finance. Mortgage companies get these warehouse lines of credit. You get $100 million, you can loan out $100 million, but then you got to package up and sell it so you can pay it back and then borrow another $100 million. So this is what mortgage companies do all the time. So according to the screen, the biggest exposure to private credit is Wells Fargo by 2 to 1 to the next best, which is Bank of America. That's a lot of exposure. So they're on the hook if these private credit funds go down, and because they're lending because they have better lending facilities through the Fed. So they're on the hook for this. That's a potential problem. Okay. It's not necessarily a problem. It's a potential problem. So keep watch for the financials. They're taking a hit this past week because this has been going on for the last few months, actually. And it's just not getting better. So we'll see where that goes, but I don't like the financials at the moment, let's just say. I think this could cascade further. I don't think it'll be 2008, to be clear. I don't think it'll be that bad, but I do think that there'll definitely be firms going under and there'll be some losses taken by a lot of investors. So I would not be in the financials at the moment. But it's just something to keep in mind because the financials tend to lead the economy, or at least the markets, and they also tend to be a weather vane for the health of the economy. So if they're going down, it means that the economy is not necessarily going to be healthy. Because if you think about it, let's say Wells Fargo, take them because they're the biggest amount in loans to private credit. Let's just say they have a lot of bad loans. Well, all of a sudden, the funds they can use to lend out to Joe and Susie Public have just been squashed. So they're not going to be lending as much. Or if they do, they're only going to lend to like perfect, borrowers, people with perfect credit scores, making lots of money, have lots of assets. They're only going to lend to perfect borrowers, which means that no one else is borrowing money. So how do you get money? Well, you got to find someone who is going to lend, which means your rates are going to be higher. So this roundabout loop turns into bad stuff effectively, until it all gets cleaned out. And it's not cleaned out yet. Basically, Doug and I have talked about this in the show: private equity, private credit. I saw a good tweet this morning by David Collum, who's a chemical, what is he? Organic biologist, I think, or organic chemist up at Cornell. Great sense of humor. I think he said, private credit. Some people confuse private credit with private equity. Private, I forget what he said. Private means corrupt or something like that. And I'm not saying that's true, but there's some humor in it, because when it's private, you can get away with a lot more stuff. It's not as regulated. There are some regulations, but not as regulated. So you tend to get a lot of the stuff happening behind the scenes, a lot of the junk. So I would just be very careful. Don't put new money in private credit. Just to be clear, do not do that. That is not smart at this point. But if you already have it in there and you can't take it out, there's nothing you can do. But if you can, wouldn't be a bad idea to take it out, depending on what's in the fund. But I want to lay one more framework. I'll hand it back to Doug to wrap it up. Is that there's a lot of landmines hiding in the system right now, and we're not going to know them all right away. So I read a good article today by Michael Burry. You remember from the Big Short. He's one of the guys who got it right on the housing market, made lots of money. People hated him. He was a guy with the glass eye, and everybody hated him because he was saying things that nobody believed, and he ended up being right. So he had a good missive this morning, and if you're watching this live, he said he'll give people access for 24 hours for free. It's on Substack. But anyway, so his theory is that we have this positive reinforcement loop, which has been caused by a bunch of things, by automatic repurchase in a 401k, by passive investing, by share buybacks. And if you look at all these things, these all turn into share buybacks. Basically increase the value of a company because there's fewer shares outstanding, which means the shares are worth more. So even though the companies may not be growing, the share price grows because they keep buyback in shares. However, if these companies are using their profits to buy CapEx into AI, then they don't have any more profits, which means they can't buy back shares, which stops that engine, which means the prices don't go up as much. You also have the automatic repurchase of 401ks. Well, that should still keep going on as long as people have jobs. But if we go into recession, that'll stop. And you also have the passive investors that just keep cranking money into passive investments. Well, the passive investments go into the bigger stocks, which is why you have these big companies go up forever. So when you have this positive reinforcement and you keep going, that's what causes these high PEs. At some point, that stops and starts to reverse. And then the market grinds lower, much like what happened to Japan in 1990 until pretty much it didn't exceed the high until I think like a year or 2 years ago. So you got to be really careful. I would be very cautious at the moment with what's going on. I'm not saying anything bad's going to happen. I'm just saying I'm at this point where I'm being very cautious to make sure nothing bad's going to happen. But I would not be overly aggressive right now. That would be my advice, even though I am not giving you advice, is be very cautious about your investing. If it's keeping you up at night, sell half. If it's still keeping you up, sell half. Sell down to your sleep level is the advice for today. If you're concerned, I mean, the markets haven't really budged. They've gone up and down. They haven't really moved. If you're concerned, you should sell down to your sleeping level till you're like, you know what? I don't care. Things crash. I'm good. That's where you want to be. Okay. If you're not there, get to that point. Because if this market's making you anxious, you haven't seen anything. This is not an anxious market. This is I wonder where things are going to go. I still have my foot on the gas, but I also got my foot just on the pedal, just in case I got to slam it on, but my foot's still on the gas. That's not a good place to be. Take it off, put it neutral, just slow it down, make sure you're on their page. You can always add back later, but exercise caution right now. That would be my advice for the week. Doug, what else you got for us?
Well, all right. So, I want to go back to private credit, the two things you discussed before I take it out of here. And I want to tie it back to housing. Right? So if we go back to private credit, it's basically the new shadow banking system. These banks like Wells Fargo aren't lending directly to risky companies. They're lending to funds that do. And that works beautifully when the credit is expanding. But if the defaults rise, if banks pull those credit lines, funds can't refinance the loans, and then suddenly the entire lending system tightens. So the real systematic risk isn't going to be banks collapsing. It is, like you said, credit tightening. And here's where a fallback is that can slow housing, business investment, job creations. That is how recessions spread fast through contagion. And private credit, Kirk, has never been tested in a real recession at this scale. The sector exploded after 2010. So the next downturn, that's going to be the first real stress test. And it kind of reminds me of all the mining that they want to do in all of these areas and these national parks. They're like, we got it figured out. We're going to make sure that we never have a catastrophic spill. Yeah, until it happens. And engineers deal with this every day. What this is very real structural risk, and it's critical because it connects to policy, banking, housing, and liquidity all into one chain. And one of the things people I think are missing right now is that how tightening policy, private credit exposure, and housing finance all intersect. And the current regulatory environment pushes banks to tighten lending standards, which it is. The natural response from banks is simply to lend less. And that's already been happening in the commercial real estate. I mean, we've seen that. We got, it's hard to get anything for commercial real estate because nobody went back after COVID. I mean, you're seeing how, buildings that sold for $400 million now sell for $10 million. And banks aren't lending against that. And small business credits got harder too. And when traditional bank lending tightens, historically, the system then shifts towards requiring more government-backed credit channels, things like Fannie Mae, Freddie Mac, FHA lending, or Federal Reserve liquidity facilities. In other words, private lending shrinks, and then the government-supported lending needs to expand. This is very Keynesian. Hey, when things break down, government better step in. And that's manageable if the policy aligns. But if the regulatory tightening and liquidity don't align, then the rippling effect can be severe. And we don't have an administration right now that wants to really put in these backing programs. That's kind of been against their rhetoric. And so this is where housing finance can show up first. You've got, banks then can reduce exposure to mortgages, commercial real estate, construction lending. That pushes it more through these government facilities. And if those pipelines don't expand fast enough, credit availability freezes. Housing doesn't collapse immediately. It just stops moving. Transactions fall, refinancing drives up, construction slows, employment follows. And then I want to add something we've been talking about for almost 2 years. This goes back, we've really been talking about it since 2022. The other problem still sitting quietly on bank balance sheets is they're still carrying hundreds of billions of dollars in the realized losses in security portfolios from the rate shock that happened in 2022 beyond. These losses exist because they bought these bonds when rates were near zero and are now worth much less. And they're not realized unless the banks have to sell. But if the bank deposits shrink or liquidity tightens, banks could finally be forced to sell those assets unless the government steps up again. And that's exactly what triggered the regional bank crisis in 2023. When losses didn't create the crisis, liquidity stress forced them into the open. And what we found during that period is that the government stepped up with basically lending on lending. They created the bank term lending program to temporarily create liquidity that saved the entire economy from collapsing with the regional bank crisis of 2023. Again, government could surprise us. Don't know what policy is going to be, but it doesn't seem like they're in a place right now that they're going to want to reactivate that program unless, again, it's to save their political behinds. So who knows what happens, but if that liquidity isn't there, that's going to be where, again, private credit filled the gap when the banks pulled back after 2008, but private credit funds still depended on bank financing lines, capital markets liquidity. If those banks tighten and capital markets slow, then the private credit ecosystem also tightens, which creates a feedback loop. You get bank tightened lending, you get private credit funds tightening lending, you get businesses struggle to refinance debt, and a lot of businesses pull interest rate debt. You've got defaults rising, and then banks tighten even further, and that's how liquidity problems spread through the economy. So the banks, still have this on their sheets, and I think the real risk isn't one bank failing; it's this credit availability shrinking across the system at the same time. Which then, where does it hit you? I'm going to come back to if you're a business owner or you're trying to invest, you're trying to get that money, that hits directly into the economy. But also, as individuals, we're talking about housing. And what Kirk was talking about risk, I want to remind people of something I think that gets forgotten when times are good. One of the biggest misconceptions in investing is this idea of risk tolerance. And people think they're risk tolerance because the markets are calm, portfolios are rising. You don't have to do anything. You just keep making money, hand over fist, because volatility was quiet. But that is not real risk tolerance. Real risk tolerance only shows itself when the ghosts in the shadows finally step into the light. That's when markets drop. That's when headlines get scary. That's when oil spikes, wars break out, portfolios turn red. And that's when people like listening might discover what your true tolerance is. Human nature is funny that way. When things are calm, we forget risk exists, and we convince ourselves that we're comfortable with volatility because we haven't had to face it in a while. But that risk has never disappeared. It was just hiding in the shadows. So when it reappears, the difference between investors who panic and the investors who stay disciplined usually comes down to preparation. And that is why structures matter, because the goal isn't pretending the risk is not there. The goal is then building a plan that can withstand it when the inevitability returns. So I'm just going to finish this out. As I close today, I want everyone listening to remember it's worth, the importance of remembering the markets in history. This isn't the first time investors have felt like the world might be unraveling. Starting to hear more calls about that. We have lived through dot-com bubbles where tech stocks were eviscerated. We've got the financial crisis where the banking system nearly collapsed, periods of stagflation, melt-ups, and irrational exuberance. And the markets always move through those cycles. Boom to bust, fear to optimism, volatility, stability. The difference for everyone listening, the families who survive those cycles and struggle isn't prediction. It is all about preparation. Now, at my company, Emergent Advisors, we focus on something most people overlook, and that's clarity. We help families map out your entire financial picture, where everything is, how it intersects, who are the most important and influential people in your life. Not just investments, but income sources, liabilities, tax exposure, college funding, retirement income, estate flow, etc. When you layer all those pieces together through wealth mapping, something very powerful happens. You stop guessing. You start to see exactly where the risk sits, where the income comes from, how your plan holds up in different environments, and whether that's a booming market, which we'd all love to, we all hope that could go on into perpetuity, or a volatile one like we're seeing now, and we may begin to see, expanded. And the difference between a thousandaire mindset and a billionaire mindset is that the thousandaire reacts to the headlines, the billionaire prepares for those cycles. Preparation means building income guardrails that allow the retirement income to continue through bull markets, recessions, stagflation, and everything in between. Those markets are always going to move. And the confidence comes from knowing that your plan's going to move with them, that you're going to be protected when the ghosts step out of the shadows. Now, if you want to see how that looks for your own situation, visit our website, mergentadvisors.net. That's MERGENT, mergentadvisors.net. Start a conversation. The goal isn't predicting the next crisis. It's building confidence on your wealth through every market cycle. And so we'll look forward to seeing you next time. Kirk looks beautiful, but he sounds better when he turns off his mute.
Thanks, Doug. I was just going on a rant there. I just shared this great wisdom with everybody. I'm sorry you guys missed it. Anyway. All right. Well, that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app we're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.